Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Entergy Arkansas Inc. 1 million BD 4.875% 66 annual report. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what may cause an entity's stock price to remain stagnant over a period of time. The stability of Entergy Arkansas LLC stock price in the past year can be attributed to several factors. One possible reason is the company's consistent financial performance. If Entergy Arkansas has maintained its revenue and profit margins, investors may not see any compelling reasons to buy or sell the stock, resulting in a stable price. Another factor could be the lack of significant industry changes or disruptions that would impact the company's operations. If the energy market remains relatively stable, with no major shifts in demand or supply, Entergy Arkansas stock price may not experience significant fluctuations. Additionally, the company's strong management team and governance structure can also contribute to a stable stock price. If Entergy Arkansas has a well-established leadership and a robust corporate governance framework, investors may have confidence in the company's ability to navigate challenges and make informed decisions, leading to a stable stock price. Lastly, it is possible that the market as a whole is experiencing a period of consolidation or stagnation, which can affect individual stocks like Entergy Arkansas. If the overall market trend is flat, it may be more challenging for any single stock to experience significant price movements. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, an increase in retail electric prices has contributed significantly to revenue growth. Additionally, volume and weather fluctuations have also played a crucial role in driving revenue up. Furthermore, updates in tariffs related to electric vehicles have led to increased revenue. Other notable contributors include the net base rate increase of $54 million, distribution cost recovery factor, DCRF, rider revenue increases, transmission cost recovery factor, TCRF, rider increases, and generation cost recovery rider increases. On the other hand, revenue decline drivers are largely influenced by factors such as a lower rate of return on rate base due to lower authorized rates. Fuel and purchased power price fluctuations have also led to a decrease in revenue. Unanticipated expenses, debt retirement, changes in nuclear fuel purchase agreements, and allocation of capacity costs have further contributed to the decline. The impact of neutral or mixed drivers is more nuanced. Changes in regulation and law, shifting customer demand, volatile credit markets, business opportunities, market volatility, economic trends, and changes in project plans all contribute to a mixed bag of outcomes. Entergy Arkansas, Inc., 1 million BD 4.875% 66 market capitalization of $1 billion, is materially smaller than most of its industry peers of roughly $33 billion. Entergy Arkansas, Inc., 1 million BD 4.875% 66 trades at a lower price-to-earnings ratio of 6 times and a lower price-to-book ratio of 0.42 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company worthy of investment, or could it be an extended period of low valuation or a value trap. The net income and profit margins of Entergy companies have undergone significant changes over the years. In some cases, net income has increased substantially, while in others, it has decreased. For instance, Entergy New Orleans and Entergy Mississippi saw a substantial increase in net income from 2023 to 2025, with a rise of 1,066% and 1,071%, respectively. This significant growth can be attributed to various factors, such as capital contributions from the parent company. However, not all companies have experienced an increase in net income. Entergy Louisiana and Entergy Arkansas saw a decline in net income from 2024 to 2025. The decrease in profit margins is also evident across several companies, including Entergy Louisiana, Entergy Arkansas, and Entergy Texas. This decline can be attributed to various factors, such as lower authorized rate of return on equity, capital structure limitations, or increased operating expenses. The changes in net income and profit margins are a result of the complex interplay between various factors, including regulatory changes, market conditions, and company-specific decisions. While some companies have managed to increase their net income and improve their profit margins, others have struggled with declining profits. It is essential to consider these trends when analyzing the financial performance of Entergy companies. The company's ability to generate positive operating cash flow has been a consistent theme throughout various reports and summaries. On multiple occasions, it is stated that the company is generating positive operating cash flow in all 3 years from 2023 to 2025. For instance, pages 65, 409, 416, and 417 all confirm this trend. Additionally, several other pages, such as 389, 467, and 474, also indicate a positive operating cash flow. However, there are some instances where the company's operating cash flow is reported to be negative. Pages 131 and 144 specifically mention negative operating cash flows for certain years. Furthermore, pages 357 and 496 suggest that the company may not be generating positive operating cash flow in all periods, with page 496 even predicting a decline in near-term performance. Despite these mixed signals, the overall trend suggests that the company is generally able to generate positive operating cash flow, particularly during the period from 2023 to 2025. The company's debt level and interest expenses have undergone significant changes over the years. One notable trend is the increase in interest expense, which has risen by $18,549 from 2023 to 2024, and by another $19,549 from 2024 to 2025. This indicates a substantial increase in the cost of servicing debt. In terms of total debt level, there are mixed signals. On one hand, it has decreased in certain periods, such as from $2,221,713 in 2024 to $1,532,345 in 2025, page 488. However, long-term debt has increased significantly in various periods, including a 432% increase from $71 million in 2026 to $378 million in 2028. Page 528. The company's ability to meet its capital needs is also a concern. While System Energy has sufficient capacity under debt tests to meet its capital needs for the next 12 months and beyond, page 529, long-term debt is expected to reach $865 million after 2030. This highlights the need for careful management of debt levels to ensure the company's financial stability. Overall, while there are some instances where total debt level has decreased, the overall trend suggests an increase in both long-term debt and interest expenses in some cases. In reviewing the performance of various segments and regions, one notable standout was the utility segment. This sector saw a significant boost in operating revenues, with a 9% increase from 2024 to 2025. This growth indicates a strong financial performance for the utility segment during this period. However, without further information on regional performance, it is unclear which areas of the business excelled or struggled. Entergy's management is optimistic about the company's outlook, driven by its commitment to delivering strong financial performance and achieving strategic objectives. The company's focus on operational efficiency and cost management has led to improved cash flow and reduced debt levels. Entergy also invests in its business, with significant capital expenditures planned for growth initiatives. In terms of capital structure, Entergy aims to maintain investment-grade debt ratings by prioritizing debt reduction, dividend payments, and equity contributions. The company's risk management strategy acknowledges potential impacts from international trade policy changes and tariffs, but notes that the effects are uncertain. Entergy also emphasizes its commitment to environmental and social goals, focusing on creating sustainable value for all stakeholders through pay-for-performance executive compensation. Key metrics include relative TSR, ETR-adjusted EPS, and environmental stewardship targets such as reducing storm restoration costs and increasing carbon-free generation. Financially, Entergy's operating cash flow has increased by $334 million in 2025 compared to 2024, with a strong balance sheet and increasing cash and cash equivalents. The company also set an adjusted EPS target performance above prior year actual performance at $3.85 per share, with a maximum performance of $3.95 per share. Overall, Entergy's management is confident in the company's ability to deliver value to shareholders while achieving its strategic objectives and environmental goals. Entergy's acquisitions and divestitures. A summary: in recent years, Entergy has been actively engaged in acquisitions and divestitures to expand its portfolio of energy assets. On the acquisition front, the company has made significant investments in various power stations and solar facilities across Texas, Arkansas, and Louisiana. Notable acquisitions include the Ironwood Power Station, Jefferson Power Station, and several solar facilities such as Arkansas Cypress Solar and Segno Solar. In addition to these individual acquisitions, Entergy has also acquired a number of other assets, including the Legend Power Station, Orange County Advanced Power Station, and Lone Star Power Station. These investments demonstrate the company's commitment to expanding its energy generation capabilities and meeting growing demand for electricity in the region. On the divestiture side, Entergy has sold several of its non-core businesses, including its natural gas distribution business in New Orleans and Louisiana. The sale of these assets generated significant revenue for the company, with the New Orleans sale netting $284 million and the Louisiana sale generating $200 million. Additionally, Entergy Arkansas sold its 2024 solar production tax credits to a third party for approximately $5.1 million. The company has also made adjustments to its unit power sales agreement, transferring shares of capacity and energy from Grand Gulf to other subsidiaries. This move is expected to streamline operations and improve efficiency within the company's energy generation portfolio. Overall, Entergy's acquisitions and divestitures reflect the company's strategic focus on expanding its energy assets while optimizing its business operations. The company has a history of paying dividends to its shareholders. In fact, there are numerous mentions throughout the document that confirm this practice. The company paid out significant amounts in dividends each year, with $1,074 million paid in 2025, $982 million paid in 2024, and $918 million paid in 2023. On the other hand, the company's share buyback activities are not as clear-cut. While there is a mention of a $500 million share repurchase program authorized in October 2010, with $350 million remaining as of December 31, 2025, it appears that this program has not been actively utilized to purchase shares. In fact, the total number of shares purchased under this program is listed as 0. It's worth noting that while the company did issue some common stock to pay for awards earned and dividends accrued in certain years, this does not necessarily constitute share buybacks. Overall, based on the information provided, it seems that the company has prioritized paying dividends over buying back shares. There are concerns about inventory buildup and supply chain disruption. The data shows an increase in fuel inventory by $10,260 in 2025 compared to 2024, which may lead to deferred fuel costs. Additionally, the potential impacts of international trade policy and tariffs on the supply chain from 2026-2029 could cause disruptions. The increase in materials and supplies by $33,081 from $157,241 to $190,322 also raises concerns about inventory buildup. Furthermore, the decrease in nuclear fuel purchases by $31,215 in 2025 compared to 2024 may indicate a potential shortage or disruption in supply chain. However, it is worth noting that some pages mention no current issues related to inventory buildup and supply chain disruption. Nevertheless, the data suggests that there are potential concerns that need to be addressed to prevent future disruptions. That concludes the financial summary for Entergy Arkansas Inc. 1 million BD 4.875% 66. Feel free to comment below, and I will be happy to answer them when possible.